So when it comes to beating the market, a lot of people think that the only way to do this is to extensively research individual companies and pick the best ones. Now, while this is a proven strategy to beat the market in the long run, it isn't the only way to beat the market in today's investment environment. It can be as simple as investing in the right industry at the right time using ETFs. So that is what I'm going to be covering in this video as I talk about 3 industries that are going to be experiencing higher levels of growth than the economy as a whole that you can invest in today in order to beat the market in the long run. So for a quick breakdown of what we're going to talk about in this video, I'm going to start us off by briefly covering what an ETF is and what benefits they provide to you as an investor. And then we're going to move into the 3 industries that we're going to talk about. So for each one, we're going to take a look at their expected compound annual growth rate compared to that of the expected compound annual growth rate of the general economy. We're going to take a look at some of the factors that are going to be contributing to that growth. And then we're going to take a look at some specific ETFs that are invested within that industry that are going to help you beat the market. Now, if you want to skip ahead to any of them, the timestamps to each of the sections are in the description down below. And if you have any thoughts regarding some of the choices that I've made, or if you think that I've missed some very high growth industries, I would love to hear your comments in the comment section down below, as I'd love to start a conversation with a lot of you guys and hear some of your thoughts on what you think are going to be the highest growth industries coming up in the future. So with that, let's get into it. So ETF stands for Exchange Traded Fund. And what an ETF is a basket of securities that trades on the stock exchange like a stock. Now, some of the benefits that ETFs provide investors is that they reduce the exposure an investor has to any single stock. And this is a big reason that investors don't like investing in any one stock, because if that one company starts to do really poorly, it impacts your entire portfolio. So that is the first benefit that ETFs provide investors, is the reduced exposure to any one stock. The second benefit that ETFs provide investors is that they simplify the investment process. If you wanted to invest in an industry without having ETFs, you would have to specifically choose individual companies to invest in and then rebalance your portfolio accordingly.
Like, damn, that sucks.
An ETF does all of this for you, and it greatly simplifies the investment process for a lot of investors, which is the second primary benefit that ETFs provide investors. So those 2 benefits, which are reduced exposure to any one stock and a simplified investment process, are the 2 primary benefits that ETFs provide to investors, and is why they have become so popular in recent years. Now, ETFs have been around for a long time, but in the past, you might have only seen ETFs that are tracking major indexes like the S&P, NASDAQ, or Dow Jones. However, today there are over 2,000 ETFs trading on the US stock exchange. Now, that is compared to around 3,500 stocks, so that just shows you how much diversity you have and how much choice you have in picking certain ETFs to invest in. Now, in this video, I'm going to be picking only the best ETFs within each industry to invest in, so you don't have to comb through the hundreds of different ETFs that are available within that specific industry. So with that, let's jump right into the first industry that we're going to be talking about, which is the solar industry. Now, the solar industry more broadly operates within the alternative energy industry. Now, just investing in alternative energy, I think, is a great option, given how much awareness is being brought to alternative energies to replace things like natural gas and oil. However, I think that solar energy is going to be experiencing the highest levels of growth out of all of those options because of its ability to be applied to both industrial solutions and the retail market. So solar accounted for just 1.8% of US energy output in the year 2019. This gives it massive room to grow and the ability to displace a lot of the current energy solutions that we have out there today. And its ability to displace a lot of these current energy production methods are going to be influenced by the following factors. The first is the rapidly falling cost of installation for solar panels. In the last 4 decades, the cost of installation has fallen 99% and is expected to continue falling as the cost of production for solar panels continues to fall. This is going to provide it with a massive headwind for growth as the retail market as well as industrial is able to afford larger and larger solar panel projects. Now, the second factor that is going to be providing the industry with high levels of growth in the ability for the solar panels to convert solar energy to electricity. In the past, solar panels were known for being notoriously inefficient at converting solar energy to electricity. However, a lot of innovations from companies producing the solar panels themselves and also companies who are creating microinverters in order to convert the solar energy to electricity have improved the ability for solar systems to convert solar energy into electrical output. And a big benefit of this is that now consumers are able to generate more electricity from their solar panels than they need, and they can then sell that energy back to the grid. So this provides a double whammy benefit for both the consumer and for the electricity market as a whole. So this is why I think that solar is going to present such a great growth opportunity in the future, and the industry also agrees, as they expect a compound annual growth rate of 36% over the next 5 years. This absolutely blows out of the water the expected compound annual growth rate of economic growth in the US, which is expected to be around 2 to 3%. So this is why I think that investing in the solar industry is going to allow you to beat the market in the long run, given the adoption rates that we're going to be seeing in the coming years due to the factors that we talked about. So now moving into the ETF that I would be investing in, I can only find one solid solar ETF. So if any of you know of any others, I would love to hear them in the comments down below. But the one we're going to be talking about is the Invesco Solar ETF that trades under the ticker symbol TAN. Now the expense ratio for this ETF is 0.71%. And what I mean by expense ratio is the fee that you have to pay in order to invest in the ETF. So if you invested $1,000 into this Invesco ETF, you'd have to pay around $7 every single year for your investment, which, given the 36% compound annual growth rate, that 0.7% really isn't that much. However, it is higher than the industry average of around 0.4%. Now this ETF obviously is invested in alternative energy stocks, and it is not limited to small, medium, or market cap, as it is a multi-cap ETF. So the top 3 holdings for this ETF are Sunrun, Solar Edge, and Enphase Energy. And actually, I talked about Enphase Energy in one of my previous videos where I talk about the #1 growth stock on the market today. So if you are interested, go check out that video to hear more about my opinion on Enphase Energy and why it's such a great company. Now, about 25% of this ETF is invested in those top 3 companies, which means it is pretty exposed to the risks of just those 3 companies. However, seeing as those are the leaders in the market today, I think that this ETF is a great option to have exposure to the solar market, and you're also going to be seeing high levels of growth coming from this ETF in the coming years. So with that, let's move into the second industry we're going to be talking about today, and that is AI. Now, I feel like I don't even need to tell you about AI because everybody is aware of the potential applications and the growth in this industry. However, I'm going to be breaking down the main points that are going to be providing AI industry with high levels of growth in the future. Now, artificial intelligence is applicable to almost every single industry out there. You can apply it to the health industry by allowing AI to provide individuals with data on their health, or as we have seen, Watson has been using AI in order to actually diagnose certain patients. So there is a lot of potential applications just within healthcare. In addition to that, automation is massive within the industrial industry, where we're going to be seeing a lot of these companies utilizing AI in order to make their processes much more efficient. Finally, in the automotive sector, we're going to be seeing a lot of growth in AI as companies start to move over to autonomous vehicles, which are going to require AI in order to allow a lot of these cars to communicate with each other on the road and learn how to navigate certain obstacles. So AI is applicable to almost every industry and is why it's going to be experiencing such high levels of growth and is going to be displacing a lot of current technology, which is why the industry is expected to grow at a compound annual growth rate of 43% over the next 5 years. Now that, similar to solar, also blows out of the water the compound annual growth rate of 2 to 3% that the US economy is expected to achieve. So for that reason, AI makes an excellent investment. However, finding ETFs that are properly exposed to AI can be a little bit difficult. So for that reason, I picked 2 AI ETFs that I believe are the best ones to invest in to capitalize off of growth in this industry. So the first ETF we're going to be talking about comes from an ETF manager that is very popular right now, and that is ARK Invest. So the one that I'm going to be talking about is the ARK Industrial Innovation ETF. And the reason why I think this one is excellent is because industrial end markets are going to be benefiting in a massive way from AI as they're able to make their operations far more efficient. So this ETF has an expense ratio of 0.75%, which, similar to the TAN ETF we talked about, is a little bit higher than the average of 0.4%. However, paying $7 on a $1,000 investment every single year to invest in an industry that's going at a CAGR of 43.5% doesn't seem like that big of a deal to me. Similar to TAN, this ETF is also invested in multi-cap equities, so they're not limited to just small, medium, or large cap stocks, and they're invested primarily in developed markets. So taking a look at the top 3 holdings for this ETF, their #1 holding is Tesla, which isn't that surprising since Tesla is a leading company in autonomous vehicles today. After that, their second largest holding, which makes up around 8.6% of the ETF, is the company 2U, which is an online education company that has been doing extremely well in bringing advanced education to the online space. And the final company is Xilinx, I think that's how you pronounce it, which makes up 6.9% of the ETF's holdings. And Xilinx is a company that's on the cutting edge of producing a lot of the technologies that are going to be fueling the AI 5G cloud industry. So for that reason, this company is invested in some of the highest growth companies that are going to be benefiting in a big way from AI. So that's the first ETF, which I think is a little bit more of a speculative ETF and might not be as consistent of a performer in the long run. And that's why the second ETF I chose is a little bit more of a safe ETF bet to be benefiting off the AI industry, and that is iShares Robotics and Artificial Intelligence ETF. So this ETF has an expense ratio of 0.47%. They are also invested in multi-cap equities, and what's a massive benefit for this one is that they are invested in global equities, whereas the previous one was invested primarily in North American equities. And as we know, China is very big on the AI scene, which is why I believe that having global exposure to the AI market is going to be very beneficial, which is why I actually like this ETF a lot more than the ARK Invest ETF. So the top 3 holdings for this company are Douyu, which is a streaming company very similar to Twitch based in China, Kingsoft Corp, which is another company based in China that is a software developer, and the third company is AMD. Now, all 3 of their top holdings make up just 1.4% of the company's total holdings. So for that reason, there's not really that much exposure to any one of these companies. So if one of them does very poorly, the ETF as a whole won't be impacted. And that is something that I really like with this ETF because I don't want to have too much exposure to companies who are going to be very volatile. For example, Tesla stock we've seen has had very wild swings in their price. And since the ARK Invest ETF consists 10% of Tesla, that's going to lead the ETF to having very volatile swings, which isn't necessarily something I want. I want something that's going to be invested broadly in the industry as a whole, so I can have a little bit more stability and peace of mind in investing in that ETF. So those are 2 ETFs within the AI industry that I believe are very solid ones to be looking out for. And the AI industry as a whole, I think, is an excellent investment opportunity, and you should definitely be getting some sort of exposure to the AI industry. So now let's move on to the third and final industry, which is the semiconductor industry. Now, the semiconductor industry is very interesting, and it's actually a very fun industry to watch, and experiences these cycles that happen every time a new and disruptive technology is developed. So in the 1990s, the compound annual growth rate for the semiconductor industry was 14% compared to its long-term compound annual growth rate of 8%. The reason why is because this is when personal computers came out to the market, and that drove a massive boom in the demand for semiconductor chips. So every single time there's a disruptive technology that requires semiconductor chips, the semiconductor industry tends to experience around 10 years of very high growth. And that is exactly what I think is going to be happening over the next decade. And the market agrees, as semiconductor stocks have been seeing very tremendous levels of growth in the last 2 to 3 years. So the compound annual growth rate that is expected to be achieved by the semiconductor industry is around 10 to 15% if you're investing in the right ETFs. So similar to the AI market, the industries that are going to be providing semiconductors with the highest levels of growth are the automotive end markets and the industrial end markets. These are the ones that are going to be experiencing compound annual growth rates as high as 35% and some lower towards the 15 to 20% range. So these are the 2 industries that are going to be driving the highest levels of growth for the semiconductor industry, and these are what are going to be fueling the next boom in demand for semiconductor chips. Now, the ETF that I would be investing in for the semiconductor industry is the iShares Semiconductor ETF, SOX. Now, SOX invests in just large cap equities, and I actually like that for the semiconductor market because it is such a large market dominated by very large players that there's not really any point in investing in very small guys, because chances are these large companies are just going to be wiping out the small guys because they are the low cost producers and they have the research and development capabilities to wipe them out long term. So investing in just large cap equities is something I really like for this ETF. In addition to that, they have an expense ratio of 0.46%, which is right around that industry average of 0.4. So I also like that about this ETF as well. So taking a look at their top holdings, they have exposure to Qualcomm, Nvidia, and Broadcom. that make up around 22% of their top holdings. Now, I think all three of these companies are set up to benefit extremely well due to their dominance in the semiconductor market. So I really like these top three holdings. And if you take a look, the remaining holdings that they have are also all great companies like Texas Instruments and Intel. So I think this is a great ETF with really excellent exposure to the semiconductor industry that is going to be able to provide you all with the ability to beat the market in the long run. So that does it for the three industries that we're going to talk about in this video. I really hope you all enjoyed and learned something new. As always, I'm not a financial advisor. These videos are for entertainment purposes, but I do hope you all learned something new and enjoyed this video. Please leave any comments in the comment section down below, like and subscribe if you enjoyed this video, and I look forward to making my next video for you all. Have a great week.